Hello and welcome to another daily dose of insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today is Wednesday, so we generally look at the trading markets in general. Let me quickly share my screen to give you a little bit more orientation, so to speak. We always start with our exchange sentiment index. So on an ongoing basis, we ask industry participants where they expect container prices to move towards in the coming weeks, and we construct a sentiment index out of that. An index above zero signals more sort of positive sentiment, while reading below zero signals that the market participants are generally expecting decreasing prices. As you can see here, the sentiment index has been picking up significantly since the beginning of July. Container market participants are expecting prices to increase towards the end of the year, which is interesting because peak season, and we'll get to that in a second as well, has been fizzling out. There's no real peak season that we've seen in terms of rates, in terms of volumes, but nonetheless, the industry thinks that there is some light at the end of the horizon. What does this mean for box prices? Let's just move to the next slide here. These are now 40-foot high cube brand new containers in Shanghai. Why Shanghai? We just come back from our intermodal trade show, the industry get together in Shanghai every year, and of course, new build prices, factory utilization, etc., was the talk of the town. And industry observers see that especially the larger production companies, CIMC, Dongfang, etc., have been able to keep production prices relatively stable. And you can also see that here on the exchange platform, prices for 40-foot high cubes have sort of oscillated between $3,000 and $3,500 US over the past months. Where now we also see relatively low volatility, so very little movement in prices from week to week. That's the chart in the bottom right-hand corner. How does this look like across the globe? Sort of a brief chart here. Northeast Asia here, you can see here 3,000 to 3,500 is sort of the price trend over the past couple of months. We're now here at 3,300, and as you can see, repositioning into other sales locations is still profitable if you look at North America and potentially Europe Med. Of course, as a trader or a smaller leasing company, especially if you're able to charge some pickup charges for those containers, so that NVOs and other market participants can use your boxes into those resale locations. On exchange, what customers then typically do is that they already pre-sell those units that are on the way. So they essentially lock in that price difference with a gate buy deal that they link to a one-way leasing deal on exchange, and sort of essentially lock in their profit margin here. Now, if you're able to buy cheap containers in Shanghai, that might be a worthwhile move for you. And lastly, let's look at further headlines of today. Just two that I picked out that I found relatively interesting. The second one I already touched upon on the first page. Kühne Nagel had an earnings conference call yesterday and really highlighted that there was no significant peak season this year, and they don't expect anything to pick up until the end of the year either. So peak shipping season is fizzling out, and that also means that for box terminal operators, yard utilization, number of liftings, etc., is really low, especially, of course, compared to last year. And we've seen numbers of Northern European port and terminal operators with yard utilization below 60%, which is, of course, relatively low. And then the second headline here, explosion of new tonnage threatens box ship charter market. Very interesting, especially since during the COVID highs, shipping lines and container sort of charter owners have ordered significant amounts of new tonnage, new vessels. The order book, the order book to fleet ratio now stands at 30%, which is an all-time high. Most of this tonnage will come online in Q4 this year and 2024. and as such significantly worsen the supply-demand balance for vessel capacity. That in turn will decrease charter rates and for liners ideally relieve a little bit the pressure on their bottom line because they suffer from lower top line revenue, and then of course sort of lower charter rates balance that out a little bit. That's it from us from today. Thanks a lot for tuning in. See you all on Friday and have a good rest of the week. Take care.